The 2021 budget, delivered by Josh Frydenberg, was avidly focused on economic recovery. On the back of GDP growth and higher than expected employment, we have seen the deficit being $52 billion less than first expected. In this next phase of the recovery plan, the government plans to spend big. Where is this cash being spent? The budget's seen many announcements injecting massive funds into aged and disability care, mental health, natural disaster mitigation and defence. But what about for businesses? For businesses, we have not seen many new incentives, but more so the extension of existing measures. We have seen the extension of both the 100% write-off of eligible assets up to 30 June 2023 and the loss carryback measures for a further year. With a massive focus on job creation, there will be an extension of the apprenticeship and traineeship subsidies with the hope to create further new placements. This will allow businesses to hire and train new staff at a discounted rate and hopefully have a positive effect on the current skilled worker shortages. Also on a positive note, the company tax rates will drop to 25% from 1 July. There will be, however, some increases in business employment costs with no deferral of the increase in the super guarantee rate, which we will see rise to 10% from 1 July. Additionally, the budget proposes to remove the $450 per month threshold, which will see all employees eligible to superannuation support. Some industry-specific wins. An extra $15 billion was injected into infrastructure projects, which should see continued activity in the construction and associated industries that work on these projects. There is also targeted injection into the aviation and tourism industries. We've already seen some of this being spent through discounted flight prices and aviation wage subsidies. However, with no hard date for borders to reopen, there will be still many businesses on a knife's edge. Lastly, innovators will benefit from the introduction of a concessional tax rate of 17% on patents income. At a personal level, many were disappointed that the Stage 3 tax cuts were not brought forward. Instead, the government has extended the low to middle income tax offset for a further year. Individuals will also have greater ability to contribute to superannuation with the removal of the work test up to age 74, as well as greater access to the $300,000 downsizer contribution with the access age reduced to 60. There is also good news for prospective first homeowners with an additional 10,000 places in the first home loan deposit scheme. Furthermore, under the First Home Super Scheme, there has been an increase in the withdrawal limit to $50,000. Both of these measures will literally allow many more people to get their foot in the door on the property market. On a final note, many will be concerned about the record level of debt we are now in. Whilst debt is high, we should remember that interest rates are at record lows, so the debt still remains cheap. We are also significantly better positioned than many other developed nations, and our strong economic position should see this debt manageable. This is just a quick snapshot of the main points. Further details of these and other announcements can be found on our accompanying resource. Alternatively, feel free to call and discuss with any of our team members. We look forward to hearing from you.